Dear viewers, welcome to this episode of Expert Speaks. Investing in large caps is quite popular. Everybody wants to invest in large cap funds. There are countless large cap funds available for you to pick and choose from. In this episode, I'm going to talk to expert of the week, fund manager Abhishek Singh, to know how somebody has to pick up the large cap funds, what exactly happens at the time of management of large cap funds, and a lot of finer points pertaining to large cap investing. Stay till the end of this video. There are a lot of interesting points that will come to your notice and help while you invest in large cap. This is NRI Money Clinic for you, and I am Dr. Chandrakant Bhatt, your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
Dear viewers, expert of the week is fund manager at DSP Mutual Fund, Mr. Abhishek Singh. Mr. Abhishek Singh comes with a rich experience of working in the fund management industry for the last 16 years. He is working as a fund manager at DSP Mutual Fund. He is a product of IIT Kanpur. He did his postgraduate from IIM Lucknow. Prior to joining DSP Mutual Fund, he has worked earlier with Kotak Mahindra Group as well as Edelweiss. Let's listen to fund manager Abhishek Singh, what he has to say in this episode. Mr. Abhishek Singh, good to have you in this episode today, and we are going to discuss large cap investing in this episode. I thought you are the perfect person to talk to my audience about everything that they need to know about the large cap. Welcome to this episode of Expert Speak of this week.
Thank you, sir. Thanks for having me on the show.
Mr. Abhishek Singh, the large cap investing is very popular. Active funds, passive funds, everybody talks about the large cap funds. The first question that is there in my mind is, what are large caps and how do you describe a large cap company?
So, Dr. Bhatt, if you list all the companies in India, all the listed companies in India based on their market capitalization. Now, what is market capitalization? Market capitalization is the total value of the company for its shareholders. So, total wealth of the shareholders in that company, that is the market capitalization. So, if you rank all the listed companies in India from the highest to lowest, the top 100 companies is what constitute the large cap universe. The cutoff for this as of December 23 is 67,000 crores. So all the companies that ending December 23 had a market capitalization of about 67,000 crores or more, they were classified as large cap. Now this number, let's say 5 years ago, was 30,000 crores. So as the market has grown, the cutoff has also grown, and this is revised every 6 months. So every 6 months on MP website, you can go and see what is the large cap universe as of today. Now, what happens is if some stocks are not doing well, they will fall below this threshold. They will their rank will be greater than 100, and then at that point in time, they will be mid caps. And the opposite of that also happens, where a mid cap gets promoted to a large cap because it gets classified amongst the top 100 companies based on market capitalization. So that is the large cap universe in India.
So there are only 100 large caps, and the smallest of the lot is at least 67,000 crore. They are huge entities, and they don't remain on the large cap continuously. The size is a dynamic process. They will either, there's a mid cap which gets upgraded to a large cap, or a large cap becomes dwarf and moves back to the mid cap. That's a perfect possibility. Now, when you say there are 100 different companies in the large cap universe, if I take the total market capitalization, what is the percentage of market capitalization which is captured by the large cap universe?
Broad numbers. So as of today, total listed market cap would be something like 330 lakh crores. And top 100 companies have about 200 lakh crores. So 62 to 63% is the representation in the total listed market capitalization of the country. So 62% of all the listed companies are basically just the 100 companies, which is the large cap universe. And this number of 62 or 63 odd percent is probably one of the lowest in the last 20 years. So, and there are reasons for that. The rest of the universe has grown, and their multiples have expanded much faster than the large cap universe. So at this point in time, the large cap universe have the lowest ever share in the total listed universe of the country, which is 62, 63 odd percent.
So what you mean to say is, in the past, the large caps used to occupy a much higher share of the pie. And today, because of the movement of other companies in the mid and the small cap universe, the overall size or the share of large cap in the total market capitalization has dropped down to right now 62 to 63%, broadly, approximation of what you see on today's picture. That's exactly what you meant.
Right, Dr. Bhatt. So 20 years ago, the large caps were almost 85% of the market cap. Today, they're 62%. But what is missed here is that their share of profits has not declined to the same extent. So, depending upon what period you are taking, the share of profits, they have been very close to 75 odd percent. So, in terms of representation in profits, they have maintained share. But in terms of market capitalization, their share has kind of come down. And this fact obviously has investing implications.
So when you say that their profitability has not come down, they still represent 75% of the profits of the stocks, but their valuation is 62 to 63% of the total market capitalization, which means they are much cheaper compared to the rest of the caps which are there in the marketplace.
Yeah, so cheaper in a relative sense, of course, at this point in time, large caps on a relative basis are cheaper to mid caps and small caps. That is very evident in this number itself. So large caps would be trading something like 10% premium compared to, let's say, small caps or mid caps, which are trading at almost 10, 20%, 30, depending on what index you're looking at, significantly higher premiums. And Dr. Bhatt, it's very obvious if you just look at the returns itself. So small caps and mid caps, they have outperformed by almost 30, 35% in the last 1 year. And these things are kind of cyclical. So we are at a point where on a relative basis, definitely large caps are cheaper.
Now, there are a lot of large cap funds in the marketplace. Every asset management company has a large cap fund offered to the investing public. Large cap fund is designed by the fund managers. You yourself is a fund manager. You say there are only 100 funds which are available. Can you take us through a brief description of how do you build a portfolio using the same 100 stocks?
Yeah, so there are 35 odd funds, large cap funds in India. And the construct of a large cap fund is that 80% weight in the fund, it has to come from these 100 stocks. So for 80% weight, my universe is very clearly defined. I cannot buy anything outside the 100 stocks. And let's say any 6 month, something is reclassified, I have to bridge the gap within a month. So 1 month is the kind of leeway that I'm given. So at all points of time, 80% exposure to these 100 companies. The rest of the 20% can be anything. It could be small caps, it could be mid caps, it could even be international stocks, it could be debt as well. I could even carry cash. Now, this is the broad structure that has been defined by SEBI in which we have to operate. Now, depending upon your investment framework, depending upon your style, you can pick different stocks from this universe of 100 stock to kind of fill the 80% bucket. So a growth-oriented investor will probably, growth-oriented fund manager will probably look at a very different profile of stocks compared to, let's say, value-oriented fund manager. That is how different funds try to differentiate themselves in terms of the kind of style that they are offering, the kind of investment approach they are offering to their investors.
See, these large caps have got an index to track. Once you have an index to track, does the large cap fund manager, he goes and recreates an index in his fund, or is there a different way of doing things? We have heard something called overweight, underweight. We have heard about terminologies called active shares in the portfolio. Can you briefly explain to me how this is done?
So, first of all, Dr. But why would you invest in an active fund? The reason why you invest in an active fund is because you want to do better than the index or the benchmark. One option that you have is just go and buy an index fund, and all index fund to a certain degree underperform the benchmark because there is some cost involved. At the same time, there is some slippage. But this is something that is very easy to do and probably the right thing to do for a large group of investors. Now, if you are picking an active fund, the only reason why you are picking an active fund is to get better performance. One of the major reasons why you are picking. Sometimes you are picking an active fund because it reduces risk, but that is a smaller subset. So to get better performance than the index, the fund manager first has to create a portfolio that is different. because if you just buy the stocks in the same proportion as the index, you will end up getting the same performance as the index. And obviously active funds also charge a little bit higher than passive funds or index funds. So that is the drag on the portfolio. The other thing that the index manager has to do is be right about the differences. So let's say if I don't own a certain large holding in the index and that holding over time underperforms, then that is how I generate differential performance. So two things are necessary and sufficient to deliver better performance than the index. First is create a portfolio that is different. And the second is be right about these differences. If I have a holding where the weight in that holding is higher than its representation in index, for example, some stock has 5% weight in the index, but I own 7% of it, then this 2% is what we call as being overweight on that stock. If I have a 3% weight in my fund, then I'm 2% underweight. So the difference between the portfolio weight and the index weight for a certain stock is the overweight or the active weight position. And if you take all the positive differences and sum them, or all the negative differences and sum them, they cancel each other out, then that is called the active share. So active share is a number that tells you how different the portfolio is from the benchmark. And why this is important? Because to beat the benchmark, you have to create a portfolio that is different and then be right about the differences.
Now, when you say that you have more active shares to beat the index, does it mean to say that the calls taken by a fund manager always goes right? Or there can be, sometimes they can also backfire?
Yeah, I wish that was the case, that all the calls taken by fund managers are always right. So no, I mean, it's very obvious that all the calls are not right. But the question to ask is, if you're right on a certain idea and you are right, and you calculate how many calls did you make and what percentage of the calls went right, people think that the hit rate, I mean, this is called the hit rate has to be greater than 50% for you to do better. But you can actually make a lot of money even with a hit rate that is significantly lower than 50%, or underperform even if your hit rate is higher. What matters is how much you make when you are right and how much you lose when you're wrong. So if, let's say, your portfolio has a lot of margin of safety in all these calls, then even if your hit rates are not great, if on a losing position you lose only 1% or 5%, but on winning positions you make 20% to 30%, then your portfolio can do well. And these are the kind of things that we analyze, that we work with, that we study, that we obsess over. And these are our anxieties, basically, whether I'm getting these risk rewards right or not. Yeah, that's the job, getting these calls right.
You also mentioned to me that 80% has to be there in the large cap. That leaves a large 20% at your discretion. What do you want to do with it? Sit on a cash call, invest in a small cap, mid cap, whatever you want to do. And how significant what you pick up in this 20% portfolio, which can create alpha for you?
Yeah, so I mean, it seems like a great bucket that can help you to outperform. At the same time, the index, the benchmark for most of the large cap funds, which is NSE 100 or BSE 100, it has 95% representation of large caps. So the benchmark that you are trying to beat has 95% large caps and only 5%. So theoretically, it should be possible to just be invested 100% in large caps and still beat the index. But that is slightly tougher. And at different points in time, you get a mid cap or a small cap idea where the risk return is very good. So obviously, you try to utilize it. But the way I think is, even my large cap portfolio, which is the 80%, should be able to beat the index if I'm doing well over time. I mean, not every year, but over, let's say, 5 to 7 years. This 20% is obviously there for you to utilize. Even if you look at some of the flexi cap funds, for example, where they do not have any limit. I mean, they can move across market cap categories. A lot of flexi cap funds, even with 80% or let's say 70 to 80% kind of large cap holdings in their portfolios, have done better than NSE 500, which is their benchmark. So I do not think this is a big constraint, or this 20% is something that you have to focus on all the time. And it also depends a little bit on a large bit, in fact, on your investment approach. So, for example, as far as I'm concerned, I don't like to experiment a lot in terms of taking exposure to new businesses, evolving businesses. I like buying boring businesses, something that is well understood, well established. So this approach also favors a large cap oriented investing. So I think even if I was managing a flexi cap fund, The approach will be very similar to the way I'm managing the large cap, maybe 5-10% here and there, but not large deviations.
Now, we all feel that large cap investing is pretty simple and people have got only 100 stocks. When I listen to you, it looks much more complex than what we all thought about. I know it's a hot seat for the fund managers. And when there are so many large cap funds there, the question that comes to my mind is, you have every AMC has said that how you try to beat alpha. But are these all large cap funds in the marketplace, they are same? Or how do we as an investor or as a distributor, I can differentiate between them? Look for certain criteria to choose the large cap. How do I have to look at the data?
So you broke off a little bit. I think the question was how to choose a large cap fund. Dr. Bhatt, the way I think is every fund that you pick performs a role in your portfolio, right? A lot of times I get this question that I have 5 funds or let's say 10 funds in my portfolio and seven of them are doing well, but these 3 are not doing well. Should I sell them? Now, if you have created a well-diversified, good portfolio, then there should always be something in your portfolio that is struggling. Because when the situation changes, when the cycle changes, when the regime changes, things that are struggling today will do better in the next cycle. So that's the first thing. Anytime you pick a fund, you have to think, what role is this fund playing in my portfolio? Is it reducing volatility? Is it giving me diversification? If you are a very growth or quality-oriented investor and you pick a value-oriented fund, that is probably there to give you style diversification. If you're picking a hybrid fund, then you know that some asset allocation is happening on my behalf in a tax-efficient manner. It will help me stay invested when there is volatility in the market, which at some point will happen. So you have to be sure what role is this playing. Now, let's say you have room in your portfolio for a large cap fund. How do you go about choosing it? And as you mentioned, there are many funds, there are 35 odd funds to choose from. So the first thing is, what is your current portfolio look like? Before you go and study what are these funds doing, first, what does your current portfolio look like? So sometimes I see portfolios where people have picked just value managers, which is fine. And something that's the kind of strategy that I'm comfortable with. But what I have realized is, you should not try to aim for the highest return, but you should aim for the highest return that you can basically get for the longest period of time. And that is usually slightly lower than trying to whatever you can optimize on a short time frame. And a lot of mistakes happen when there are drawdowns in the portfolio and you get anxious or you get worried about what's happening in the portfolio. So this diversification bit is very, very important. So if your portfolio is already value biased, maybe you want to look at a growth-oriented fund. Now, how do you judge this is a growth-oriented fund or a quality-oriented fund? I think this is the responsibility of the AMC or the fund manager to tell you, this is my style, this is my approach. When you're buying an active fund, you're not getting a portfolio, but you're getting an investment approach. And then the job of the channel partner or the investor is to study this approach and basically make sure that it aligns well with your thought process. Or if your thought process is completely opposite or different, it is you understand that fund is there in your portfolio to give you diversification. Now, no matter who the fund manager is, it could be one of the greatest of all time. It could be somebody new. It could be a systematic strategy. Every style or a fund manager will go through a lean patch where when you're looking at your portfolio, you will figure out that this fund is not performing well. And that is the point where if you've chosen well, you have to stick with that fund manager. This will only happen if you have belief in the approach, if you have belief in the thought process, if you really have confidence in the ability or the ability of the fund manager or his style. Your returns are a function of the fund manager behavior and your behavior. And that is why I keep telling people that eventually your investing outcomes are a result of a partnership between the investor and the fund manager. And how will this partnership work unless you have confidence in the approach in the fund manager and his style? And that is why it's very important to spend time. It's like choosing a friend or marrying somebody. You have to spend a lot of time understanding what is it that this person is doing. And is it solving a problem for me in my portfolio, either by giving me diversification, reducing the risk, or this is something that I have so much confidence in that I can go through whatever volatility. Eventually, all strides will go through a phase of volatility. Can I sustain that volatility and stay invested for 5, 10, 15 years? I think a long investment horizon covers for a lot of investing mistakes. And that can only happen if you trust the style, trust the fund manager. And this is the responsibility of the fund manager or the AMC to give you enough documents, enough material, enough explanation, so that you understand what is the approach and what is the style, and then take the call.
So the time heals everything is very much applicable in the investment world as well.
Yeah, absolutely. I mean, this is one domain where this is probably very, very important. You can make a lot of mistakes if you have a long investment horizon. It compensates for it.
I have seen during my investment journey or being a distributor, I've seen some fund managers lagging behind, but we had faith in them and they had a convincing story to tell, especially with respect to PSUs, with respect to banking. It often happens with pharma. It has happened right now with technology. So once in a while, it keeps happening. So it's difficult for the fund manager because you're not facing the investor. It's a difficult job for the distributor because we face the investors. We have to explain to them. Finally, the investors will listen, provided we give them a complete case why it is happening like that. It's just a matter of time. And people who stay invested during those troubled times obviously reap that benefit of, getting the spike from that underdogs, and they'll compensate. That's bound to happen. I'm very sure about it.
Two comments here. One is, stories are very easy to build and convey in our industry. So at times you have to be skeptical because because this is not math. A lot of things that do not make sense could be conveyed in a manner which sounds sensible. And the other thing is, it's not easy because we are not directly in. So there are a lot of direct investors as well. In fact, for both of my funds, there's a dedicated email ID and retail investors write to me. And anyway, for us, even the channel partners are our clients. So we are constantly in discussion with them. And the thing is, it's wrong expectation that at all points of time, everything in your portfolio should be performing. I think that is not the most optimal portfolio. As I said, there should be something in your portfolio that should be struggling at all points in time. So if everything is struggling in your portfolio, then that is obviously a problem. But if everything in your portfolio is doing well at the same time, maybe that is also a red flag that you are not diversified enough. And in the next cycle, it could hurt.
One question that is there in my mind, how much is the factor of luck in case of a fund manager? Because you can do everything. You can put it on Excel sheet. You can do the research. You can do everything. But there are things which the market forces will dictate. Is there a factor that the luck plays in the life of a fund manager?
For a large part of my career, I was a trader, and Taleb, the author of Fractional, he says that as a trader, the only thing you can do is try to increase the serendipity around you. That means you try to create structures that increase the odds that you get lucky. So obviously luck plays a large role, but my job is to get into the situation where the odds of getting lucky are high. You try to do your bit, you work hard, you try to do everything that is in your control, and then you hope that the gods are kind. So yes, luck does play a big role. At the same time, the job is to get into situations where the possibility of getting lucky is higher. And I can give you a few examples where it has happened in the portfolio.
One question is that everybody wants a return. And we tell our customers, don't chase the return. Rather, you put up a proper process in place and the returns will come as a byproduct of that process.
Absolutely.
Is it the same thing in case of a fund management industry also, that you don't endeavor to create return, rather you stick to your process and let the market forces work, and over a period of time, the returns will come?
Yeah, so I think so. What happens is across a variety of situations where you confuse the goal that you're trying to achieve with the strategy that is needed in place for you to achieve that goal. Getting higher returns over time is a goal. Strategy cannot be, I'll have higher returns over time. So my goal is that I do better for my investors. I beat the benchmarks over full cycle, 7 to 8, 10 years and deliver higher returns. But I cannot say I'll deliver higher returns by delivering higher returns. You have to break it down. What all do I need to do so that I achieve my goal? That is the strategy. And then every day you have to focus on the strategy. I have shared my investment framework. I have shared my valuation framework. I think those are sound. My job on a day-to-day basis is to execute that strategy. Am I executing this or not? And as you said, the returns are incidental. It's incidental for the investor. It's incidental for the portfolio manager. Every day you chop wood, you carry water, you chop wood, you carry water. And then eventually, if you're right, if you have the right thought process in place, right structures in place, right operating procedures in place, processes in place, then eventually things take care of themselves. That is what has been my experience.
One question that comes to my mind is, as an active fund manager, can you beat index over a longer period of time? Is it possible? Is it not possible? A lot of people have got a lot of questions around that.
This is something that I've chosen to do with my life. So, of course, the answer is yes. Otherwise, why would I do it? But the challenge is you cannot do it every day. You cannot do it every month. You cannot do it every quarter. You cannot do it every year as well. And that is why I tell my investors that my endeavor is to beat the benchmark over 5 to 7 year cycles. So if you invest in my fund today, sometime between next 5 to 7 years, you should look at the portfolio and see that I've beaten the benchmark, and then you can take a call whether you want to exit or you want to stay invested for, I hope you stay invested for another 5 to 7 year cycle. That is the endeavor. As far as large caps are concerned, beating the benchmark has been extremely difficult. In fact, if you look at the SPIVA reports, SPIVA is S&P Indices Versus Active. It's a report that is publicly available. You can Google it. Almost 93% of the funds in the large cap space, they have struggled to beat the benchmark. And the moment I share this data, people say, oh, 93% of the funds are not beating the benchmark, let me index. 100% of the index funds are not beating the benchmark because there's a slippage and a cost involved. So your opportunity cost is what you can make in an index fund versus what you are making in an active fund. And if you compare those, almost there's a 50% probability that over the last 5 years, an active fund actually beat a randomly picked Nifty fund. And the odds are very high, very difficult, basically. And I think I can do better. And at some point, if I feel this is something that I cannot do, then I will cross that bridge when you get to that point.
Now let's move from understanding large caps to what is happening in the marketplace today. Indian indices have been climbing high. Of course, we are seeing a little bit of a correction in the last few days. The markets have retraced a bit. From a valuation perspective today, where are the different caps of the market, the large cap, mid cap, small cap stand, and where are the funds flowing into? Which caps the markets are moving the funds into?
Yeah, so as far as valuations are concerned, and Nifty is trading at forward multiples of, let's say, 20x. Last 20-year averages would be 15.5, significant premium. Mid caps are trading at 27x, so significant premium to even Nifty, and majority of the time actually they even traded at a significant discount to Nifty, and today 20x versus 27x. Small caps would be something very similar to Nifty, 20x, but again they have also historically traded at discount. So I mean, this is just one way of looking at valuations, and actually not a very good way. The other ways, you try to, for every category, you look at, are there enough bottom-up ideas? So if the markets are cheap, fund managers are spoiled for choice. There's just too many ideas that filter into your framework. At this point in time, I think this is not an idea-rich environment, and I have been convinced that for some time that has been the case. Most of the retail funds are, retail flows are into mid cap and small caps, and that's reflecting into the rally indices. Large caps recently have actually seen outflows, and this is the typical behavior of the investor, rich and poor both, where there is a lot of pro-cyclical performance chasing, which is whatever segment is doing well, money will flow to that segment. Whatever style is doing well, money will flow to that segment, and this actually ends up hurting performance. So one example that I frequently quote is there was a point, a year ago or so, we studied one of our funds where the fund return over the last 15 years was 17%, but the average investor in the fund was making only 8%, which was very shocking to us, that how can you, average investor, make only 8% when the fund performance itself is 17% CAGR. And the reason why this happens is, when the fund is doing well, that is when you get all the money, and when the fund is not doing well, you see redemptions. And this happens with funds, this happens with market caps, it happens with sectors, it happens with themes, it happens with countries, it happens across the board, across all countries, across all type of investors. Pro-cyclical behavior, performance chasing. And this is something that it's hard to kind of correct, but it's a low-hanging fruit. This is one of the first things that you should address.
So, which means to say that people are doing exactly the wrong thing. The right thing could have been that they buy something which is underperforming, give it the time, and wait for that to come up a cycle, and that's where they would have made a lot of money. But here, what happens is that they change the pattern and move towards something which is a momentum, and the bargain is that they don't get the return. That's exactly what happens.
Absolutely.
And most people come and sit on there when it's about to change. Now, from a fund manager's perspective, what is the message you would like to give to the investors? Let's say if somebody is building a portfolio today and he has to have large cap, mid cap, small cap, what do you feel should be the proportion he should carry in his portfolio?
Yeah, so recently I wrote a letter to my investors, and one thing that I mentioned is, so obviously it's very hard to know what style will work, which fund manager. So these are difficult questions, and that is why, there's a lot that some of our channel partners, advisors can do in terms of helping these clients create portfolios. But these investors, both small and large, they have an overwhelming advantage in terms of the plan, the simplicity of the plan that they need to execute, which is save consistently, have the right asset allocation, and be patient, have a long listening horizon. The second part of this, which is having the right asset allocation, this is very important. And I think everybody's trying to go for the highest return, but, and this is my hunch, backed by some data that we have, which is most investors are making single-digit returns on a post-tax basis on their overall portfolio. So if 100 rupees is what you have in your savings, you are probably making 9, 10%, sometimes even 7, 8% on a post-tax basis on your overall portfolio over last 5, 10 years. If that is the case, then there is no point asking which fund is giving you 20% return or 30% return. First, you have to ask yourself, if the equity markets in India have delivered 12, 13, 14, last 20 years, it has 15% return. Why is it that you are making some 6% or 7% or 8% return? As we discussed before, this is happening because of pro-cyclical behavior, because you invest in something which you do not understand, or you invest at the wrong time. And when there's volatility, you exit. Instead of that, pick something that you can stay with for the longest possible time. And that will automatically give you better returns. A simple thing that I suggest most investors to do is, do not change any decision before 7 years. Any decision, you take your time. There should be high threshold for action. You take your time understanding why you want to make a certain change in your portfolio, why include a fund or drop a fund or take exposure to a new theme, new sector. Take your time. But once you've taken that decision, stay invested for 7 years, and after 7 years again. This simple change itself, I think, can add multiple points to your overall return. At this point in time, another thing that I want to convey to is temper your return expectations. Markets are rallied a lot. If you already had a good exposure to equities or a decent asset allocation, you're already sitting on a lot of gains. This is not the point where you get more greedy. It's okay. You do not have to make all the future returns in the next 1 or 2 years itself. It's a long journey. Try to avoid accidents. Be a little conservative at this point in time. So if you invest at a point where small caps and mid caps are very expensive, then, for example, in 2008, if you invested in small caps, over the next 10 years, the small cap index actually delivered only 6.3% return, which is, lower than Nifty, lower than even fixed income. Over a very, very long time period, 15, 20 years, are small caps and mid caps in India going to do better? Probably. I would say the odds are they do slightly better than large caps. But they also come at the risk of volatility. So if you will be well behaved in a drawdown or in a crash, then you should have higher exposure to small caps, continue with your SIPs all the time. But if you think you're a conservative investor, you get worried, maybe at this point in time, stick to large caps, or lump sum exposure should go to large caps.
I heard a report which says the money moving into small cap has been much higher than the money which is coming into the large caps. Does it warrant caution for the new investors or the existing investors? Is it a time that they can think about booking some profits out of this small cap?
Yeah. So, see, booking also comes with its own set of challenges where there's tax outflow, right? So if you invested just 1 year ago, you're probably sitting on 50% gains in small cap. So if you sell today, there's significant tax outgo. And you have to be very, very cognizant of this, because over time, this adds up to a lot, in fact. So the other way to think is, so if you're not selling and your income streams are still open, you're building cash in your portfolio, incrementally, it's better to adjust the portfolio based on incremental flows that you're getting. So one way to reduce risk is, for somebody who wanted to have a 60-40 equity debt allocation, because equities have rallied so much, that 60 has probably gone to 40, 70 or 80. Now, this is the point in time where whatever incremental flows you are getting, probably you can also consider investing in debt, or let's say conservative hybrid funds, so that your equity portion keeps reducing. That is a better way of kind of adjusting the asset allocation in the portfolio, more tax efficient way. Other thing is, if you don't want to get all these hassles, you can pick hybrid funds who do this on your behalf. And as I mentioned before, most investors, I think 80 to 90% of the investors in the country, they are not getting the returns of even a conservative hybrid fund in the industry on a post-tax basis because of these errors. So something that sounds boring but works really well.
Thank you very much, Mr. Abhishek Singh. There are a lot of points the investors can take from here. One thing which came out here for sure is you have to give time. Forget about large caps, small cap, mid caps. Forget about the fund manager. The real returns making thing is your behavior as an investor. Are you prepared to give that 7 years time? You called it right, called it wrong, but stick with it and stick with it without changing anything for 7 years. The odds of you raking good amount of money from the markets are pretty real. But if somebody is trying to chase the return and you tend to exhibit a behavior which is pro-cyclical, meaning you are chasing the return and you are looking at rear view mirror and trying to position your funds, anything can go right or anything can go wrong. That's the takeaway for me from this discussion I had with you. Thank you very much for your perspectives on investing. We started with a knowledge sharing on the large caps and we moved to other aspects, fund movement, small cap, risk reward payoff, and how investors have to position their portfolios. Thank you very much for your kindness to spare your time for the sharing of your knowledge with my audience. We remain in gratitude to you for your kindness and your time. Thank you very much, sir.
Thank you, Dr. Bhatt. Thanks for having me.
Dear viewers, hope the conversation I had with fund manager Abhishek Singh gave you a lot of insights into how the large cap funds are being managed, the limitations, the opportunities, what you should look out while you are investing in the large cap. If it did give you insights into all these points, do not forget to like this video. If you are a person who is watching this channel for the first time, or if you are yet to subscribe for the channel, please hit the subscribe button and press the bell icon. Do not forget to share these videos with your near and dear ones, friends and relatives, and on all the WhatsApp groups on which you are connected with. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you next Tuesday with yet another expert, with yet another topic. Till then, stay safe. Jai Hind.
Press the bell icon for more details and subscribe our channel.